Thank you for that introduction, short and sweet, and thank you, ladies and gentlemen. So I'm going to talk, the title of my talk is Apart from Gold, What Else? But let me start by saying I am incredibly bullish on gold for the next 2, 3, 4 years. I couldn't be more bullish. And the reason I say that is because all of the drivers of gold, all of the drivers that have pushed gold up over the last 3 years remain intact. If anything, they've become more urgent last year, but they all remain intact. And we have new drivers as well, most notably Tether. Tether, as you probably know, is they run the US stable coin. They're about the 8th largest holder of treasuries in the world. And they've launched a gold-backed stable coin, which they estimate, and their goal is to have the same growth in the next 5 years as the US stablecoin had in the past 5 years. Tether alone, many of you may not know this, Tether alone in the second and third quarter, we haven't got the fourth quarter numbers yet, but in the second and third quarter, they purchased more gold than any central bank in the world. And we all talk about the central banks, but they are becoming a very, very significant buyer of gold. So I'm extremely bullish on gold. But what I wanted to talk about today was something a little bit different, and that is, apart from gold, what should we be looking at? Well, this is a chart some of you will have seen before showing commodities generally, and it includes agriculture and everything, commodities versus US stocks. They have never been as cheap or as undervalued as they are today. And as you can see on this graph, undervalued by a significant amount. And commodity stocks, that's the equities, they also have lagged and lagged dramatically, as you can see on this graph. And the fundamental reason for this is a long period of underinvestment. Resources generally do not move, the cycles for resources do not coincide with economic cycles. And that's a really important thing for investors in this space to really understand. We assume that when the economy is strong, then the demand for commodities will go up and the price will go up. What's really critical with commodities is the investment cycle. And as you can see on this graph, we've had a bit of a pickup in the last couple of years, but the trend here for the past 40 years is definitely, 45 years, is definitely downwards. And particularly for oil and gas, that's in the black, and also for agriculture, less so for industrial metals, but the others. And so the cycle of underinvestment would suggest that we are set now for rises in the prices of pretty much all commodities. Now, of course, we all know that gold has moved ahead dramatically. It's moved ahead of the commodity index in the last couple of years, and that's why I wanted to talk about what else apart from gold. But please keep remembering, I am extremely bullish on gold, and I think gold is the asset right now that has the best risk-reward of any commodity and probably any asset or market I can think of, the best risk-reward. But other things are more undervalued. And this is gold and the GDX, which is the largest ETF for gold mining equities, for gold equities. Gold and the GDX have again left the S&P in the dust for multiple years. In fact, for 25 years, gold has outperformed the S&P. Most generalist investors don't understand that. And so here you can see, let's start with the bottom one first. Gold has outperformed copper, notwithstanding the fact that copper price is at all-time highs, and the copper equities, of course, have done remarkably well. Gold has still outperformed copper fairly significantly in the last few years. And of course, gold has dramatically outperformed oil for reasonable period of time now. So this is a table, I get it from US Global. They call it a periodic table. And this is really interesting. I'll come back to this in a second. But I want you to look at lithium. So you look at lithium, and it's close to the bottom, close to the top, bottom, bottom, halfway up, top, top, bottom, bottom, and then moving up. Exceptionally volatile. Volatile in itself, but also obviously volatile relative to other things. So this is the price of lithium for the last few years. It started to pick up again, and I think there are very strong fundamental drivers for lithium, particularly this new fourth generation batteries, which are faster charging, last longer, and they're going to be a big demand for lithium from those batteries. It's begun to pick up, but of course the price is nowhere near where it was in 2023, which itself admittedly was a spike. Now, there's so many things about I started, looking into the lithium market. I don't mean just yesterday. I started looking into the lithium market, and there's so many factors about that market that make it a very, for my view, unless you're an expert on lithium, it makes it a very difficult market to really have a good feel for. And so my approach, knowing that lithium, I don't know, but thinking that lithium is likely to continue to be a very volatile commodity, and all of the indicators suggest that, the big increase in production from China, even as the price collapsed and Australia cut back on their production, China boosted their production. So when the price picks up, Australia will come back, but China will probably continue to produce. So the prices are likely to remain volatile. And given the volatility, and given that I'm not an expert, to me, the best way, the way I'm investing in lithium is through other companies that I like anyway, but are not exclusively dedicated to lithium. So number one would be Midland, which is an exploration company, and they explore for gold and copper and zinc in Quebec. They've got a great balance sheet, great management, lots of joint ventures, including with Cisco or whatever they're called now, and VRIC. But one of the alliances that they have is with Rio Tinto, which is dedicated to looking for lithium. So if that alliance, and Rio is just upped for the third year in a row. So if that alliance is successful and they find an economic lithium deposit, that will be incredible for Midland's stock price. But if they don't, then Midland still has other things. So I like something like that. I also like to buy lithium through Altius. Altius, most of you will know, is a great company, a royalty company, diversified across the whole commodity space. They recently bought Lithium Royalty Company. Now that represents so lithium now represents over 20% of the pro forma company. It's not closed yet, but it represents over 20% of a pro forma company. So they are making a huge bet on lithium close to the bottom. But these are good people, strong people. They've made these kind of contrarian bets in the past. They've been very successful. So for me, some of you will differ, but for me, I would rather get exposure to lithium through Midland and Altius, where if lithium falls apart, Midland and Altius remain successful, and I haven't lost all my money. Let me just quickly go back to copper. There's another thing I still like, despite the high price. I think because of the underinvestment, remember in commodities, the important thing is not the economic cycle, but the investment cycle. We've had years and years of underinvestment in copper, and we're heading into a period for a year or two of great scarcity, in my mind. The copper market right now, in my view, cannot withstand another disruption, like Grasberg going offline, for example. They cannot withstand another disruption like that without another meaningful increase in prices. So I like that. Oil is probably the most undervalued. It's a hated commodity. People think we're not going to be using carbon, we're not going to be using oil and gas in 10 or 15 years. That's just absolute nonsense. The narrative on oil is just completely wrong. We're still going to be using oil into the 2050s and probably into the 21st century. The demand continues to grow steadily. And the important thing is there's a narrative put out, in fact, by the International Energy Agency that the world is oversupplied in oil. We're not oversupplied. The single biggest growth driver for oil production in the last decade was US shale. US shale, in fact, represented more than 100% of the world's growth in oil production. And all of the US shale fields are peaking, if they haven't already peaked. Some of them have already peaked, and this is fact, this isn't speculation. I mean, the production is declining one by one at each field. We don't really know how long those tails are going to be. There's speculation that the tails on shale may be the fall off may be a lot sharper, and the tails a lot shorter than on conventional fields. I'm not a geophysicist, I'm not going to speculate on that. I'm just going to say that they have peaked, that's fact. They are peaking, fact, and the production from US shale is going to continue to decline regardless of what incentives are put in place by the US government. So copper, oil, lithium, I think these three things are all very, very attractive commodities to be looking at. But if we're looking at what else apart from gold, and again, I remind you that I am exceptionally bullish on gold, what else apart from gold? Well, we want to look at equities outside the commodity space. So let's just look at the US stock market. This is I don't know what you call these things, but a dot plot or something of valuations in the US stock market going back to 1927. It's price to book and price to earning, and dividend yield, sorry, price to book and dividend yield. This is all the way up to 1988. And every single valuation metric falls within that box, other than three times, only one of which was outside the box on the upside. That's all the way to 1988. Since then, look at that box all the way down in the bottom. Virtually every single year, since 1988, the valuation on the US stock market has been higher and increasingly and significantly higher than those 50-year, 60-year valuations prior to that. So it strikes me that the US market is not just overvalued, but on a secular basis, on a long-term basis, it is overvalued and dramatically overvalued. Now, of course, the US stock market recently, for the last 15 years, has been driven by big tech. Just how overvalued is big tech? This is NVIDIA. NVIDIA may be the best company in the world. It may be a wonderful company, a great company. But NVIDIA alone is bigger than the UK market. It is 30% bigger than the Canadian market. You could buy Germany, Singapore, Hong Kong, Sweden, and Spain instead of NVIDIA. You could buy every small cap stock in the world outside of the US for less than you would pay for NVIDIA. When you look at it in that way, does that make sense? However good a company NVIDIA is, would you rather buy the entire Canadian market, notwithstanding Carney? Would you rather buy the entire UK market, notwithstanding Starmer? And we could go through all of them. But hey, who's the president of the US? I'm not going to get into that. So they are incredibly, the big tech in the US is dramatically overvalued in and of itself and relative to other markets and other sectors. There's the entire gold mining sector down there in the corner, and there's the entire North American oil sector down in the corner. So we could throw those two in on top of Germany. You could get all of Germany and all of the gold stocks in the world and all of the North American gold stocks for what you could get NVIDIA for. I think I've made my point. So for the last 15 years, as I say, the market in the US has been driven by big tech, and that has driven extreme overvaluation relative to the rest of the world for the past 15 years. Sorry, let's just go back a second, if I can. So I've got the US against the world. The US is now more overvalued against the rest of the world than it has ever been in its history. Another way of looking at that, of course, is the rest of the world is more undervalued relative to the US than it's ever been in its history. It's recovered in the last year, and this graph does not do justice to the outperformance. The World ex-US, that's the Morgan Stanley Capital International World ex-US index was up 33% last year, while the S&P was up 17%. So it's not clear just by a quick glance at this graph, but the world outperformed the US by basically 100% last year. Now, typically, you do not get, these things move in longer cycles. As I say, it's been 15 years that the US outperformed up until last year. It was 8 years before that the world outperformed the US. It was 10 years before that the US outperformed the rest of the world, and so on. The cycles tend to be long. You do not get 1 year where the rest of the world outperforms the US and then just turns around and that's all. There are fundamental factors as well, of course. The valuations, what's happening in the US, I won't say any more, and the dollar. Remember, if you're a US investor, or if you're a Canadian investor and you buy Canadian stock and the Canadian dollar goes down, well, your stock might go from $10 to $15. You think you've made a 50% profit. But if a Canadian dollar has declined, a foreign investor has not made a 50% profit. So as the dollar declines, foreign investors are going to start putting less money into the US market. For basically 15 years until last year, foreign institutional investors were pouring money into the US market. That's slowing, and I think it's going to continue to slow, particularly as the AI bubble bursts. So several reasons why the foreign markets are likely to continue out to perform. How much will they outperform? Well, foreign markets, on average, would have to grow 25% a year more than the S&P, so 25% more than the S&P for 5 years, just to get back to their 55-year average valuation, relative valuation. They would have to go up 2.5 times to get back to the previous cycle lows. So timing, I'm not so sure, but the undervaluation of US stocks, of foreign stocks rather, is just amazing. And I'll end with this. Yeah, there you go. They've never been cheaper. I should have shown that earlier, sorry. One of my favorite markets right now, and I'll close on this, is the UK market. You can see the UK market, until last year, has basically gone nowhere for 20 years. And yet these are good companies, very undervalued. You can get dividend yields of 5 and 6%. The average dividend yield is 4.5%. Good price earnings, good balance sheets. A lot of them are exporters, so it doesn't matter about how low the pound goes, because they're exporting, so that makes their exporters stronger. So this is a market that I really like. And then here's a couple of other markets that I like. Singapore, Hong Kong, well, that's not a couple, that's a few. Singapore, Hong Kong, and Brazil. As you can see, until last year, all of these markets dramatically undervalued relative to the US. So don't sell all your gold by any means, but there are a lot of other things in the world that are significantly undervalued right now. Thank you very much.